I'm going to go ahead and get this puppy started. Jeremy Doorn, again, enrolled agent with CORE, relationship manager. I'm Christian Brim, the guy with the cowboy hat. I'm just here to sing along. So what we got today is just a big overview. It is not intended to apply to anybody in particular. We're just trying to pick out some of the common things. But I will tell you that the last couple of years, all of the changes, it has never been more important to work with a professional on your taxes for your business. It's not an option. So let's get started. There's us again. I labeled it tax mayhem because this year we had not only changes that affected last year, but changes that affected the current tax year. And then they're not done. So all of this is subject to change according to what Congress has up their sleeve. So here's the outline of what we're going to cover today. I'm not going to read to you. You can read it. This recording will be available, so you can reference it afterward. Just check back to our website and our downloadable content. So first thing I want to discuss, Jeremy, federal aid.
Federal aid, yes. The EIDL has been extended. They had a max of $150,000 that you could get from the EIDL, from the SBA. They've extended that to $500,000. Mm-hmm. I'm not 100% sure all of the things that go into getting that extra $350,000, but going to the SBA website, you can go and see if you're eligible. If you need more money, obviously it has to be repaid, so it's not like it's an actual loan. But
you're never going to get 30-year money at 3.75%.
Well, and I think some of that got reduced to like 2.8 something too, and they extended the payback. So if you get the additional money, they're pushing back the repayment back another 24 months or 12 months or something. So, yeah.
Well, and the other thing, when I read the original legislation, it said that it was just for high impact areas that had, suffered more than others. And when I discussed it with the SBA, they said it's going to be based upon zip codes. I haven't seen any rhyme or reason to it. So I guess my advice would be log into your SBA portal if you had any IDL and see if you're eligible. Don't assume that you're not.
Yeah, go get it. Go get it if you can, especially if you need it. And then PPP, at some point on these webinars, we're not going to talk about PPP anymore at some point. I don't know when that is, or we might just continue. But the forgiveness, just more of a reminder about getting those forgiveness applications turned in, just to get them off your balance sheets. They do make a difference with some S corps for basis purposes. So if you have losses that you could potentially take, it actually builds basis for you, so you can take those losses. So if you don't get it forgiven until next year, then you might have some suspended losses that you can't take until next year, and owe some tax this year. So
definitely. And the banks, the SBA has been pretty quick. The banks have not been so quick on processing them or even accepting them. So it's a good reminder.
Yes. And then the employee retention credit, probably one of the most confusing things I've seen in several years. But if there's any chance that you might get this credit, it can be good chunks of change. We are going to have 3 years to go back and amend 941, so we do have some time, but it's been extended through the end of this year, so we can keep looking at quarters to see if you're down or if you meet the requirements to get those credits.
And we have a webinar recorded on the subject with examples, so check it out.
Yes, absolutely.
We're not going to discuss it here.
Thank goodness.
All right, so on to the new stuff.
Yeah, so one of the new things I think that everybody's heard about, or most people have heard about, that's been in the news and everything right now, is this advanced child tax credit. They have extended the child tax credit or increased it from 2,000 up to 3,600 for kids under 5 years and under, and then 3,000 for those between 6 and 17. They're actually, the IRS has gone through and they're going to pay half of it in advance starting in July, so the last 6 months of this year. So when you come to your tax return, if you meet the gross income requirements to be eligible for it, then you would have already gotten half of these credits. So if you had children under 5, then you would already, your credit would be $1,800 because they're paying these out in advance on a monthly basis. Go ahead.
So it's not a new credit, they're just advancing the credit.
Well, it's an increase in an existing credit and paying half of it in advance.
Okay, so if you get a random check from the IRS, it's not necessarily a mistake.
It's not necessarily a mistake, but you do have to know that because you can go and onto irs.gov and you can opt out of these advanced child tax credits if you think you're going to be over the income levels, or if you just don't feel like getting the money in advance because you like getting a big refund in April. But I think what I've advised people is, hey, you know what? If they're going to give you money, just take it now. Just know that you might have to pay part of it back if your income ends up being over a certain amount, because then they start phasing it out down to the 2,000, and then eventually the 2,000 gets phased out after that. So there's a couple of steps to phasing it out as far as income goes. But yeah, just making sure that you know that they did increase the child tax credit, but they are giving it to part of it in advance. So I think it's going to throw some people off in April when it's like, wait, my refund's not way bigger than it usually is, and they increased the child tax credit. Well, no, they've already given you half of it. So,
got
it. So charitable donations. This was changed, just modified a little bit this year. Last year, it was changed with I think it was the CARES Act or whatever it was last year.
Yep.
That typically when you have charitable donations, the only way you get to use those if you itemize. And since the Trump tax cuts or Trump whatever tax proposals, they've doubled the standard deduction. So a lot of people don't get to itemize. And so you typically don't use those charitable donations. Well, last year they let you take $300 of cash donations and use those as a deduction, even if you took standard deduction. This year it's actually doubling for married filing joint. So you can take $600. So if there's charity or some nonprofit out there that you want to give money to, it's still you can still get part of a deduction for giving to those. Not that you should use taxes to donate, but you still can get a part of the deduction for it.
If it's a motivator, it's a good thing.
Hey, it all adds up, right? All right, on to the advanced premium tax credit repayment. So this one was huge last year for a couple of different clients of mine and probably many taxpayers out there. So just like the advanced child tax, oh my God, I can't get these. I can't even keep these straight. The advanced child tax credit. This is the government giving you credits for healthcare premiums if you are eligible for that subsidy based on your income level, right? And so if they base it on your income level from the prior year and your income goes way up, but you don't adjust, then when it comes to your tax return, it all gets reconciled and you might have to pay part of that advanced premium tax credit back because you're not eligible now.
Right.
And so like some of them can, sometimes the repayment's limited, and then other times it's not limited if you make like 4 times the poverty level based on your taxes. And last year they came out and said that for the tax year 2020, that none of the premium tax credits had to be repaid. So if you would have known that, you could have gone and told them that your income was $10,000 and gotten your healthcare paid for 2020 and not had to repay it. But so there was a lot of people that didn't make that adjustment, and then they didn't end up having to pay that back. So that ended up saving them tens of thousands of dollars for sure.
And so for 2021,
2021 is not like that unless something changes, but it hasn't been it hasn't been extended through 2020. So it's just if that's one thing to check. I mean, if you're making more money than you usually do, you might want to check and see if you're still eligible for that premium.
well, I
tax
guess the
credit.
worst case is you have to repay it. If not, then you roll the dice and they say you don't have to pay it back. You're good.
Well, yeah, and you just have to know that you might have to repay it back, and then there's things that you can do too. Because if you get under a certain threshold, you only have to pay a portion of it back, right? So, like if you're married filing joint and you fall between 300% and 400% of poverty level, then you have to pay it back, but it's limited to like $1,200. So maybe you got $10,000 worth of tax premium tax credits, but you only have to pay back $1,200 of them. So then you can just kind of play it. You got to kind of look at the income and see if you can get under that 400% threshold. So
Very good.
yes.
Let's go on to retirement plans. This is one that I think that business owners don't look at enough. The default is, I think, with a lot of small businesses, is simple, which is always a good place to start. But to know that a 401k and a defined benefit plan are also options if you need more deductions. There's also more flexibility in the 401k that you can't get in a simple. Things like vesting, things like loans, things like Roth accounts. So there's a lot of additional features you can get for the 401 with the 401k that you can't get with the simple. Now, if you already have a simple, you can't make contributions to a simple and a 401k in the same tax year or calendar year. So if you have a simple, you're going to have to wait to start the 401k January 1. But if you want to do a 401k with a safe harbor provision, which basically limits the amount that you as the employer have to pay, and it makes it very comparable to what you'd have to pay under a simple, you have to have that plan set up by October 1st to get the notifications to the employees. So that is something to consider. Jeremy would be happy to do an illustration for you and show you the difference in the contributions and the tax savings. If it's just you or you and your spouse, the single K is absolutely free to set up. There's no administrative fees for it. But you get all the benefits of the 401k. Well, not all the benefits, but most of the benefits. You get the increased deduction, increased tax deduction. And then the defined benefit plan, if you're a business that has consistent cash flow and consistent profit, those benefit plans allow you to sock away a tremendous amount of tax deductions. It has to be done. It does not have to be done with a 401k, but it usually is done in conjunction with. And it works really well when you have owners that are older and higher compensated than the employees who are younger and less compensated. So professional companies, doctors, lawyers, engineering, architect, all of those where you have partners that are making big money and they're over 50, and all of the people doing the actual work are 25 and 30-year-olds and not getting paid anything. Those types of businesses are ideal for the defined benefit plan. We also have a recording on the retirement plans on our website if you want more detail on those. Jeremy, did you have any comments about that?
No, I was just going to say the other thing in here that people always talk about and might hear that people might be talking about is a SEP when you're self-employed, just by yourself or whatever. And I've always told people, and especially now, is the SEP allows you to stick it in for yourself, but the contribution limits and the deductions that you can take in that are limited. So you can usually, especially because if you got a solo 401k and you're a single owner and you're the employee, typically it's going to start making sense when you've got like a when you make an S corp election. So you're going to be limited to whatever your salary is, how much you can stick into these plans. And the SEP doesn't allow you any profit sharing contribution, or it doesn't allow you the 19.5 of the initial deferral to go in. So you can stick a lot more in that solo 401k. So I've always liked solo 401ks compared to SEPs for sure.
So I'm going to go ahead and launch our first poll. Question basically is, what do you think your taxes are going to be this year versus last? More or less or about the same? I'm going to guess that most people are going to say more because last year was shit, but let's see what comes up. So it looks like about 2/3 of you say more. Less than is only 20%, and that, that makes sense. I get that. All right, so on to my favorite subject, capital gains harvesting.
Yes.
So currently, capital gains are taxed differently than ordinary income. We'll talk about how they're talking about changing that. But one of the things you get in a volatile market is unintended consequences from your investments. Day traders are the worst on this because they'll end up having huge gains and then give it all back. And although the net result in their investment account is zero, they've got a tax consequence, especially when it straddles tax years. So the concept is that your gains and your losses offset each other. But if you have a net loss, you're only allowed to take 3,000 of that per year. So if you had a bunch of gains this year and you recognize those, and then you end up giving it all back in the stock market the first quarter of next year, well, you're let's just use a dollar amount and say $50,000 in capital gains this year. You lose it all back in the first quarter of next year. Well, you're stuck with that $50,000 loss that you got to eat up at $3,000 a year if you don't have any other capital gains to offset it. So it's a key point to be working with your investment advisor and your tax person. With core, it's the same person, but making sure that you have a strategy and you're monitoring it. I have an example here that just shows a client's holdings where at this is a snapshot, but these are the actual gains and losses. Well, the real ideal situation is to get those close to equal. Now, you don't want that to be driving your investment strategy, but all things being equal, you don't want to pay more tax than you have to. Jeremy, do you have any experience you want to share on that?
No, not specific, but I think the biggest thing too is to get, if you have a bunch of those losses, you can sell this stuff and reinvest in it and get your step up in basis and pay absolutely no tax on it, which is kind of where you're going with all of this, is trying to eat up those losses, because using them over 15 or 20 years is going to do you absolutely no good.
You raise an interesting point. You do want to be aware of the wash sale rules, which basically say you can't buy and sell the same asset in 30 days. They basically, to do what you're saying, clear out the washes. But there are ways around that. But just know that is one of the.
Well, but you can, you can still sell it again and then buy it again.
Correct.
Yeah. So you can't sell at a loss and then buy it. But yeah.
So I'm sure you've had this conversation with a client before. It's the end of the year. I made money. What do I need to buy?
Office building. Wait,
is that a common question you get?
Yes.
Like, how much money do I need to spend before the end of the year? Right?
Yes. All the time.
And with the current tax structure, it's very tempting because you can write off pretty much anything and take the tax deduction. The problem with that is that you set yourself up with a tax liability for the future because you've taken all of the expense now. This table illustrates how you can, the number columns are different tax methods that you can use. And you can end up taking all of it or some of it. But the point is that generally speaking, you need to look at multiple years when you're doing your tax planning, because you don't want to have this year when you don't have income to buy equipment, you don't have any income to offset, but you've got you've expensed everything that you've already bought, and you're kind of relying on that deduction, and then all of a sudden you've got $100,000 more in income than you're expecting and a big tax bill.
Yes, and I think the other thing to look at too is if you're financing this, it gets even worse, right? So if you're financing it over 5 years and you expense it all in the first year, then your cash flow is going to be seriously hurting the next 4 years because you're going to be paying for this thing and getting no deduction but paying taxes on it, right?
Absolutely do not want that. That's like the worst scenario ever, is when you have cash out and no tax benefit.
Yeah, and the other thing I tell people is if you need equipment, it's fine. We can go buy equipment, write it off if we need it, whatever. Don't go buy equipment or buy cars just to buy cars and equipment just to write them off. That's
100%. You're in the business to make money, not avoid taxes, right? I mean, at the end of the day, and you shouldn't let the tax code be the tail that wags the dog, because at the end of the day, if you spend $1 and only get a 50-cent tax deduction, you still don't have the dollar. I mean, that's the end result. So buy assets based upon your business need, not for taxes.
Make sure they're making you money. If they're assets, they should be making you money. If they're not making you money, they're sure as hell not assets. They might be listed as assets, but they're not assets.
Mr. Kiyosaki is smiling on you.
Yes.
My little rich dad, poor dad reference. All right. So one of the other things that is now is a good time to look at is your entity selection. So talk about your experience with clients on making these entity choices.
Oh man, I think the biggest one you have listed there is the first one, is the S Corp election. I mean, going from sole proprietor to S Corp it can be huge, and especially going forward, it might be huge the first year, but it's only going to get bigger as the years go on, as you make more and more money. So that one is just a huge one to save on self-employment tax. I mean, sole proprietors just end up paying so much in self-employment tax, and being an S Corp ends up just saving them. I mean, I just did tax rejection for somebody that is going to make the S Corp election for this year, and this year alone, we're going to save $10,000.
Well, that's hard to argue with. Although I will play the devil's advocate, and I will say that with the current tax rates, C Corps aren't necessarily bad, right? I mean, there are some benefits, especially if you are a startup, if you're growing, if you're plowing all of your profits into the back end of the company. Especially if you're planning on a sale, like a tech startup where you're building stuff and you want to sell, C corporation might be the way to go, because you're never going to come into that dreaded dual tax situation that you have normally in a C corporation.
Well, and that's if you can get a stock sale, right? So if you do an asset sale in a C Corp, you're going to end up with double taxation, and the C Corp it's only going to pay a corporate level. It doesn't even have a capital gains rate. So any of those capital gains are now taxed at 21, which is above all the personal ones too. So
correct.
I agree. There are specific reasons.
Point is, look at it.
For sure.
The partnership, we don't see a lot of, but one of the main benefits of a partnership that people don't really understand is that you can share your profits and loss differently than you own the equity. So a lot of times this comes into play when you have a money partner and an operating partner. And so somebody puts in the money and the other person does all of the sweat equity. Well, that money partner may want to see all of the losses up front, because they generally have a tax situation while the sweat equity person doesn't. They're not making any money. Partnerships have a niche. They really are good for certain things, and in some industries they're more standard. Oil and gas, real estate, those types of things. But it's always good to revisit the entity that you're using on, maybe not every year, but if you haven't looked at it since you formed it, it's probably good to just revisit it with your tax preparer. Any other comments on entities?
No, I've got nothing.
All right. So let's talk about accounting method. Everybody talks about accounting methods, right?
Yes.
So, this is a concept that I think business owners struggle with, but it's pretty straightforward in the sense that the IRS says you have to pick an accounting method and you have to stick with it. You can make changes to your accounting method, but unless you meet certain criteria, the IRS has to approve it. So it's not necessarily something that you can change automatically without the IRS's blessing, but it is something to look at. So the cash basis is pretty straightforward. If you received it, you include it as income. If you wrote a check or had a credit card charge, it's an expense. Accrual is what they teach us in school as accountants. And that's just a concept of trying to match the timing, the economic timing of income and expenses. So a typical way this shows up is accounts receivable. If you bill something but haven't gotten paid on it, it's an accounts receivable. On the accrual method, you're going to show that accounts receivable as income. On the flip side, if you have incurred an expense, but you have not yet paid it, it's called accounts payable. Well, if you haven't paid it, you still get to deduct it under the accrual method. Generally speaking, if your accounts payable are at or above your accounts receivable, the accrual method is going to generate a lower income for you. Understand that it's timing, and over time, theoretically, it all should wash out. The IRS is going to get paid, but it's something to revisit. The options to move to a cash basis are automatic if you have $5 million in revenue or less. Anything else has to receive an approval from the IRS. The inventory and depreciation methods are also things that you can change. Not a lot of people have inventory. Some do, but how you account for your inventory can make a huge impact on your taxable income. All of this to say, you need to have a tax projection. Jeremy, talk to me about what this process looks like.
So I think this is something that we do every year with our clients, and starting here I've already done several. What month are we in? August. So we usually start July or August. We start annualizing out business income for their businesses and looking at any other things that might affect their taxable income for for the current year. This is from 1920, or 2020.
1920?
Yeah, 1920. But looking at the current year and kind of projecting out, a lot of times we don't change like interest from bank accounts and stuff like that, because that stuff doesn't change a lot. But the thing here is trying to get what we think you're going to owe next year close. right? I don't want you super overpaid and I don't want you super underpaid. Because if you're super underpaid, you're going to pay penalties. And if you're super overpaid, you're not going to get any interest from the government. And you could have been using that money to
Well, you get a
use it.
little, but
Uh,
yeah, you've got better uses for it.
You got better uses, right? So I had a client that um, had just come onto core and he had always paid a lot. He had always just given a lot. He had some formula that he had come up with to give money to the government for taxes prior, like for his estimated taxes. And so when I came to do his tax projection, I showed him that he was like $30,000 overpaid already. And it was like September of the current year. And he was like, "Are you kidding me?" And I'm like, "No." I said, "You're so overpaid. You don't need to pay in anything in it, like at all." And he was like, "Oh my gosh, that's such a relief," because he had another, I don't know, $25,000 sitting there that he wanted to use on marketing and was trying to use on marketing, but he wasn't going to use it until he paid his taxes next year. And he got to go and do his marketing campaign right then and there and build his business right there because he knew exactly where he sat as far as what might be owed next year or what might be owed back to him.
Yeah, and you show here on this one like two alternatives, and we can do multiple alternatives. So multiple scenarios, what ifs. This shows multiple years, and I think going back to the depreciation conversation, it's critical that you look at multiple years. In this environment, it's kind of hard to predict. I mean, no one could have predicted last year. But you don't want to just make a decision that impacts this year because you don't know what's going to happen next year. But you can know some of the variables, right? We don't know if Congress is going to change the tax rates, but we do know that if we do X, Y is going to show up over here. So making sure that you're looking at a multi-year plan.
Yeah, and I think the ones that you had before, the different alternatives, that can be good for showing different filing statuses, right? I can show a sole proprietor what you would pay for sole proprietor versus if we make an S corp election, what's that going to do to you? So you'll know exactly how much you're saving right there in front of you.
So talking about unpredictability, let's talk about my favorite subject, Congress. And doing the research for this, looking at the Tax Policy Institute, this is the White House's proposal. It seems to be the one that's getting the most traction, but never know what's going to come through the sausage mill of Congress. What is being proposed are increased individual rates, increased corporate rates, capital gains tax as ordinary income, elimination of the step-up basis. This is absolutely huge because when you die, your heirs receive a step-up in basis based upon what the value of that is at the time. So if you own $1 million piece of real estate that you bought for $200,000, if you sold it before you died, you have $800,000 worth of capital gains. Well, if you die before selling it and give it to your heirs, they get the property and their basis is now $1 million. So if it goes up from there, they pay tax on it. But that $800,000 that was your gain before you died, it goes away. It never gets taxed. And Congress is considering limiting that step-up basis. I think it's $1 million. But that's huge. On the same vein, they're looking at limiting 1031 exchanges. 1031 exchanges or like-kind exchanges happen mostly in real estate, but can happen in other assets. But basically,
no, not any longer. No longer. It's only real estate now. It changed.
Oh, it's only real estate. Sorry,
it's only real estate now. Yes.
So the concept is that saying you bought a property for 200,000, it's now worth $1 million, and you want to sell that and buy something else. Well, you don't have to pay tax on it if you use a 1031 exchange. You just roll it over your new property. You still have that $200,000 basis. You don't get a step up, don't get it confused, but you defer that tax as long as you keep buying like kind real estate. They're looking at limiting that. They're looking at increasing the net investment tax, which is basically the Medicare. So they're putting a Medicare surplus on all your net investment, but they're looking at increasing the threshold, and they're also looking at applying it to everything. So it's like, here's your top tax rate, but really there's this extra tax rate if you're over this extra income. So, which I think is the net investment tax is 3.8.
3.8, it is.
Yeah. So awful. The last is the business loss limit. Now this is not new. This is in existence. It is suspended with the CARES Act for last year and this year, but they're looking at making that permanent, which means that if you have a loss in a given year from your business, you're only going to be able to take a certain amount of it and have to carry the rest of it forward. Looking at the pros on the plan, I didn't see any. And I mean that seriously. I'm not trying to be flippant, but from a taxpayer standpoint, from a business owner standpoint, there was nothing in there that was beneficial. What are your thoughts?
Yeah, I mean, we can joke about there being no pros, but I mean, everything in the plan or the proposals that I've seen is taxes going up, and they can tell me that it's on only people over a certain amount or income or whatever. But small business owners, a lot of them fall into those categories, and it's I don't think it's going to be good for business, but.
Right. And that goes back to the multi-year plan. So if you're doing your tax planning for this year, do I want to bring in income now and pay at a lower rate? Well, I don't know. It could be that they make it retroactive for this year. I mean, that's not unheard of. So they may change the tax rates for this year. We don't know. But it's those types of things that you need to be having conversations with your tax preparer about. I'm going to launch this poll. What are your all's thoughts about the Biden tax? What do you think it's going to happen? Not going to happen? No idea.
I can't answer this.
No, you can't answer that. You're a panelist.
I know.
Sit there and look pretty.
I can do that.
No, you can't. I set you up for failure. I'm sorry. Yeah. Everybody thinks that they're going up. That's what my gut says. Honestly, we'll see. All right, so that comes to the end of our presentation. We have a question from the, no, we don't. Hold on a second. Mr. Taylor, would you put your question in the Q&A or the chat? Stand by, everybody. Do you have any final comments while we're getting questions from Jason?
No, I think you said at the beginning, if last year didn't, we'll say scare, that's in air quotes, if all these tax changes didn't scare you into needing a professional tax preparer, somebody that does this on a daily basis, there's just no reason not to work with somebody if you've got a small business to do some of these planning actions.
So Jay, here we go. Here's the question. If I put money into Coinbase and then it goes off from there into some crypto investments and then comes back into Coinbase as a profit, how and when am I going to be taxed on it? It's a great question.
So I'm no crypto expert, but as far as I've researched, any of the crypto stuff is going to be reported just like stocks and stuff. So you'll have basis what you put into it, and then you'll have the sale of what you got out of it, and you'll just pay capital gains based on short-term or long-term, depending on how long you held it, as far as I know.
Correct. Oh, no, I agree with that assessment. I think there's a huge push by the feds and governments worldwide to get their arms around this issue because there's so much money there that wasn't there 5 years ago. They're really behind the curve on it. There's been some rumblings that they don't want to treat it as a capital asset, but that's not the way the law is written. Of course, if they change the capital gains rate, it's not going to make any difference. So this is a follow-up question here. So I would get the same IRS tax statement from Coinbase like I would get from any other trading platform. And that the answer is yes, you should. Follow-up question. With crypto, everything I've read is that the wash rule doesn't apply. So you can actually sell at a loss to claim the losses and then rebuy immediately. This is because crypto is classed differently. This concept has been circling the internet a lot. Is that accurate? I haven't, here's the thing. If the IRS says it's a capital asset, then the wash rules apply. If the IRS comes out and gives us some type of other authority saying it's not, and it needs to be taxed differently, then the wash rules wouldn't apply. I've seen, I have some crypto that's with a institution based out of New Jersey, and there are several states that are trying to regulate them, saying that you are issuing a security and it's not really a the account is not an account, it's a security. Well, you got conflicting interests between the federal and the state, right? State wants to regulate it as if it's a security, but the feds really don't want it to be a security because they want it to be taxed as ordinary income. I don't know where it lands. It's going to be interesting.
Yeah, I don't think there's any specific guidance on that. I think that's more of a, like you said, if they say it's a capital asset, then it's a capital asset for now, and the rest of it will catch up. But and we can call it an asset and say, well, the wash rules don't apply, but that guidance will catch up to it. I would think.
Well, I'm going to ask this question from Mr. Taylor. Cool, thanks. How is Brim not aged in 30 years at all? Clearly, your camera and/or your screen is not functioning correct, because yes, I have been gray for life, but I am much more gray and much more fat. Any other questions from the from the group? Any final thoughts from you, Mr. Doorn?
I'm good.
All right, with that, I will wave goodbye until the camera's gone. Thanks, everybody.